If you are trying to make the biggest decision in your life, making big investments, buying a home, investing in the stock market, and trying to understand which direction the market is moving, then this is the right video for you. Is everyone talking about inflation? Inflation occurs when there is an excess of demand over supply, leading to an overall increase in prices for goods and services in an economy. In the last 50 years, how many times we face inflation issues? 1970s oil crisis, 1980 Latin American debt crisis, 1990 Asian financial crisis, 2008-2009 global financial crisis, 2020 inflation concerns after COVID-19. What does the central bank do to control inflation? Central banks use various monetary policy tools to control inflation. Here are some common strategies. 1. Interest rates. 2. Open market operations. 3. Reserve requirements. 4. Forward guidance. 5. Quantitative easing, QE. These are some of the primary tools and strategies that central banks use to control inflation and maintain price stability in the economy. The specific measures adopted by a central bank depend on the prevailing economic conditions and the central bank's monetary policy objectives. To reduce inflation, central banks and governments typically implement contractionary monetary and fiscal policies. Contractionary monetary policy. Central banks increase interest rates to make borrowing more expensive. This discourages spending and investment, which helps to reduce demand in the economy and slow down inflation. Additionally, central banks may sell government securities through open market operations to decrease the money supply, further curbing inflationary pressures. Contractionary fiscal policy. Governments can reduce inflation by decreasing government spending and/or increasing taxes. By reducing government expenditure, the overall demand in the economy decreases, which helps to mitigate inflationary pressures. Similarly, raising taxes reduces disposable income, leading to lower consumer spending and decreased inflation. Supply-side policies. Governments can also implement supply-side policies to address inflation by increasing the capacity of the economy to produce goods and services. This can include investing in infrastructure, improving education and training programs, and reducing regulatory burdens on businesses. By increasing the supply of goods and services, supply-side policies can help alleviate inflationary pressures caused by supply constraints. Exchange rate policy. In some cases, countries experiencing high inflation may choose to adopt a tighter exchange rate policy. This involves allowing their currency to appreciate relative to other currencies, which can help reduce the cost of imported goods and services. Lower import prices can help dampen inflationary pressures by reducing the overall price level in the economy. Wage and price controls. Governments may implement temporary wage and price controls to directly limit the increase in wages and prices. However, these measures are often controversial and can have unintended consequences, such as distortions in the allocation of resources and reduced productivity growth. Inflation targeting. Some central banks adopt inflation targeting frameworks where they publicly announce a target inflation rate and adjust monetary policy to achieve that target. By anchoring inflation expectations, inflation targeting can help reduce actual inflation rates over time. These strategies can be used individually or in combination to effectively reduce inflation and maintain price stability in the economy. However, policymakers must carefully consider the potential trade-offs and unintended consequences associated with each policy tool. If you like this type of content, then like, share, and subscribe for more valuable insights on investment strategies and financial literacy. How does interest rate impact inflation? 1. Cost of borrowing. Effect on consumption and investment. Exchange rates. 4. Effect on savings. 5. Cost of borrowing. When central banks raise interest rates, borrowing becomes more expensive for consumers and businesses. 5. This reduces the amount of money available for spending and investment, leading to lower aggregate demand in the economy. 6. As demand decreases, businesses may lower prices to attract customers, contributing to a decrease in inflation. 7. Effect on consumption and investment. Higher interest rates tend to discourage consumption and investment. 8. Consumers may reduce spending on big-ticket items like homes and cars due to higher mortgage and loan payments. 8. Likewise, businesses may postpone or scale back investment projects due to increased borrowing costs. 9. Reduced spending and investment can lead to lower demand for goods and services, putting downward pressure on prices and inflation. 10. Exchange rates. Higher interest rates can attract foreign investors seeking higher returns on investments denominated in a country's currency. 11. This increased demand for the currency can lead to an appreciation in its value relative to other currencies. 12. A stronger currency makes imports cheaper, putting downward pressure on domestic prices and inflation. 13. Effect on savings. Higher interest rates incentivize saving rather than spending, as savers can earn more interest on their deposits. 14. This can lead to a decrease in consumer spending and contribute to lower inflationary pressures. 15. Cost of production. For businesses, higher interest rates can increase the cost of borrowing for financing production activities. 16. This can lead to higher costs of production, which may be passed on to consumers in the form of higher prices for goods and services. 17. However, this effect may not be immediate and can vary depending on the industry and market conditions. Overall, the relationship between interest rates and inflation is complex and can be influenced by various factors such as economic conditions, monetary policy stance, exchange rate dynamics, and expectations of future inflation. Central banks carefully monitor interest rates as one of the key tools for managing inflation and ensuring price stability in the economy. Individuals can take several steps to manage the effects of inflation on their personal finances. 1. Budgeting. Create and stick to a budget that accounts for inflationary pressures. 1. Adjust spending priorities as necessary to accommodate rising prices for essential goods and services. 2. Saving and investing. Save and invest wisely to protect against the erosion of purchasing power caused by inflation. 3. Consider allocating funds to assets that historically have provided returns that outpace inflation, such as stocks, real estate, and inflation-protected securities. 4. Diversification. Diversify investment portfolios to spread risk across different asset classes and sectors. 5. Diversification can help mitigate the impact of inflation on investment returns by reducing exposure to any single asset or market segment. 6. Managing debt. Be cautious when taking on debt, especially during periods of high inflation. 7. Fixed-rate loans may offer some protection against rising interest rates, whereas variable-rate loans can become more expensive as interest rates increase. 7. Consider refinancing debt to secure more favorable terms if possible. All hedging against inflation. Not a bad idea to investing in assets that tend to perform well during inflationary periods, such as commodities like gold and oil, real estate investment trusts, REITs, and Treasury inflation-protected securities, TIPS. 9. These assets may provide a hedge against inflation by preserving purchasing power over time. 10. Earning potential. Invest in education, skills development, and career advancement opportunities to enhance earning potential over the long term. 10. Higher income can help offset the impact of inflation on living expenses and maintain a comfortable standard of living. While monitoring expenses, regularly review and adjust household expenses to identify areas where costs can be reduced or optimized. 11. Look for opportunities to save on recurring expenses, such as utilities, groceries, and insurance premiums. 12. Inflation-indexed products. Consider purchasing inflation-indexed products, such as inflation-adjusted annuities or inflation-linked bonds, which offer protection against rising prices by providing returns linked to changes in inflation rates. By implementing these strategies, individuals can better manage the effects of inflation on their finances and maintain their purchasing power over time. However, it's essential to consult with financial professionals to develop a personalized inflation management plan based on individual circumstances and goals. In conclusion, managing inflation is crucial for individuals to safeguard their financial well-being amidst rising prices and economic uncertainties. By budgeting wisely, saving and investing prudently, diversifying portfolios, managing debt effectively, and exploring inflation hedging strategies, individuals can mitigate the impact of inflation on their finances. Additionally, staying informed about economic trends and seeking guidance from financial professionals can help individuals develop proactive strategies to navigate inflationary environments successfully. With careful planning and informed decision-making, individuals can better protect their purchasing power and achieve their long-term financial goals despite the challenges posed by inflation.